Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We're here to answer your questions. We are going to be trying to help you with your retirement planning, your asset management, tax planning, those types of things. So send in your questions. Send them in now, send them in after the show. You can do it two ways if it's during the show. One was the email that you see here on the screen. And then also you can put it in the chat if it's live. We'll try to answer those questions as we go. And of course, we have our channel. You can subscribe to the channel. Go to there, hit the subscribe button. Just looks like that. There's a little bell button if you want to get notified when we're putting in new content. We feel that education around the concept of retirement is something that's important. There's your health and all those types of things, but the financial portion of your retirement is something that we're going to try to help with here as much as possible. And of course, lastly, if you just want to meet with us and ask questions directly, you can do that also. There's a book appointment button on our website for our business. The address for the business, the link is here on the channel. That button that you see right there, that orange yellowish button is sitting up in the corner. And our schedule's on there. You can pick out a half-hour time to meet with Ethan and I, and we'll be happy to answer your questions, on a custom basis. So really looking forward to this. We've been gone for a while. I think the last show that we did was the December 13th.
Yeah, it's been a bit of time.
Yeah, we always take off the end of the year for the holidays and what have you, and then Ethan's been off on a trip, and so I actually have some pictures that he gave me. I'll share those with you. You might find them kind of interesting. Just a couple. I have a lot of clients that love to travel. So,
yeah.
So where is this at here? It's a beautiful picture.
So I was in Cambodia for this picture, and so this is near Kampot, which is kind of a southern province, and this was near the Green Cathedral, which is kind of like a little river loop near the palm groves, and so this was the sunset in a kayak, so it was really nice.
That's pretty cool.
Yeah.
Yeah, I like it. And then how about this one here? So I was going to ask you, is that an alcoholic beverage or is that
no? It's just some pineapple juice,
Okay.
fresh pineapple juice.
Good.
But this is Kep Beach. There's a really good crab market near there too.
Oh.
So if you want fresh crab.
Which country?
Cambodia.
Cambodia
again.
still,
Yeah,
okay.
yeah.
And then which countries did you go to altogether?
So I went to just Cambodia and Thailand. So
Oh, okay.
the two, yeah.
Seems like enough, to be honest. And,
This was Wat Arun, which is a temple in Bangkok, Thailand. Is really nice. It's pretty crowded with tourists, but it's a very nice temple.
yeah, it looks really, really intricate.
Yeah.
Must have spent a lot of time making that thing. And then the last one here.
So this is the Kulin Mountains. So it's the cliffside near in Cambodia. So this is near Angkor Wat area. So Siem Reap and Angkor Wat. So it's about an hour north of there.
I have some pictures like this from some of my backpacking trips, but I wasn't quite that close to the edge.
Yeah. It's interesting because like when you see like the countryside, it does like because Cambodia is like a lot of the dirt is like a red clay. It kind of reminds me of that Arizona at times, but more green Arizona.
Yeah, my wife's from Oklahoma. They have a lot of red clay there too. Yeah, exactly. All right, we'll get back to our previously scheduled programming. Thought some of you might find that interesting. Of course, we always like to start off the show, with a summary of what's been happening in the stock market. And it's been quite the interesting ride here altogether. Really, if you look back to the middle of November to now, the market's pretty much in the same spot. We've been trading in a range. There is some inputs that are definitely happening that seem to be, driving things one way or another. So if you kind of look day by day, the key things that are moving the market one way or another are what's happening with inflation. And there's a bunch of pieces of that, the jobs report, what the Federal Reserve is saying, the CPI reports and the PCE inflation reports that have been coming out over time here. And of course, the other thing that seems to be moving the market one way or another has to do with these tariffs. And so, looking at this week, for example, on Monday, the market was down 2% at the beginning, essentially. Because of the threat of tariffs that were announced on Friday of last week, that were supposed to come into play over the weekend. Turned out they were going to come out on Tuesday, which is what I think the 4th, right? And so, but on Monday, they sort of resolved, at least for 30 days, the tariff situation with Mexico while the market was open. And the market came back up. We went from -2% to -0.75%. After hours, they actually resolve the situation with Canada. Also, similar scenario, just agreements on what's going to happen with the border and those types of things. But the 10% tariffs that were announced against China are still there. They've been talking. We'll see what happens there. And the problem with these tariffs is it's not as easy as it sounds, just in the sense of it's often not a blanket tariff. It's on certain goods, and so certain isn't. And I know the tariffs that were part of the 2018, tariff raising situation were exactly that, kind of parsed up against, China for certain things. And I think what they're seeing, though, is there's a lot of ways around those, and so they're trying to kind of fill in some of those loopholes and what have you, too. So today's a good example of kind of what's going on. It kind of has all the pieces. So first of all, we had the jobs report that came out today for last month. So for January, there was 143,000 jobs created, which I think is a good number. But the expectation was that it would be a little bit higher.
Yeah.
Okay. But the market went up. It was up about 0.25% right after the report came out, because that's kind of exactly what you want. You don't want hot job growth per se, because we're in an inflationary environment. But you don't want it to be really low, because then we start to worry about the recession that might be coming. And so being a little bit below expectation is good. And that was also combined with revisions for December and November upward.
Yeah.
Most of you might remember they did a big revision halfway through last year, and I think they dropped it by 800,000 jobs for the first half of the year or what have you. That's a big overstatement, but that's kind of how it works. So in this case, they're actually revising them up. And the December jobs report was actually quite good already. It was 256,000 jobs. Matter of fact, that dropped the market, I believe, about 1.5% that day when it came out. And but they've revised that up to 306,000 jobs, and they revised November up also. So I think the job market's doing really well. The wage growth is outpacing inflation, so that makes for good consumers.
Yeah, happy consumers.
Yeah,
good for market.
And then so we're up in the morning, and then all of a sudden we're coming down, and there were two main catalysts for that. One is the announcement that we would have retaliatory tariffs, maybe immediately. Who knows what happens? We'll see how that plays out. But one of the examples was given that if a European car coming into the U.S. is being a tariff of 2.5% right now, a U.S. car going into Europe is a tariff of 10%. And so kind of equaling those out. And we also had consumer report coming out, consumer sentiment survey, which was not as good as the previous ones.
Yeah.
So you have a situation where the combination of those two, as of we're speaking now, we were down about 1% for the day. And we were pretty close to getting back to a new all-time high again. And so there's some concern there, because, you keep coming up and then failing. You're starting to create double tops. You're starting to create different situations. We'll see how that plays out. But I don't think there's any significant threat to the market as we speak here. There is a lot of concerns about what might happen. And this is one of my key themes that I talk about all the time, is that, people are asking me, well, should we be doing something to our portfolio because of the new administration or what have you? Well, the problem is, what's the new administration going to do, and what is the impact for the stock market going to be? Let's say that they do tariffs. Okay, so theoretically, that's potentially inflationary. It's also potentially, an issue for the stock market, because that's the key thing the market's looking at right now is inflation. So, but at the same time, you don't really know if it's going to have a negative impact for sure. I mean, if you look at the first downturn that's right over the Talk with Money thing here on this chart, that was 2018 when they first did tariffs. It dropped 19.6%, and then they stopped doing tariffs. It came back fairly quickly as far as that goes. So, we have a pattern, but what normally happens in those patterns is, people realize, oh, it's more of a buying opportunity because it's not a calamitous situation, or at least it wasn't in 2018. We still have those tariffs for the most part.
Yeah, and I think it's the stopping of new tariffs is the big deal. It's as long as there's no additional tariffs going out, I think the market is happy. Like once the tariffs are established and kind of set in place,
right,
I think the market will adjust, and then we'll kind of move on.
Yeah, that's exactly right. And so because of that thought process, you might end up with a situation where the market just doesn't pay as much attention as people think it might to that situation. So, we dropped 19.6%, but maybe the next time this happens, we only drop 5 or 6%. Who knows? And so that's that we've seen that in the debt ceiling, right? First time they did debt ceiling 2011, market dropped 17%. The last time we had a debt ceiling argument, market was down 3%. So it's sort of the situation where the market gets more used to it, and it is new things, like you say, so new tariffs. And so today the market's down. I would say, in my opinion, looking at what happened minute by minute to the market, it had more to do with the talk about tariffs than anything else in terms of the downturn, as far as that goes. But all the way through here, we've been getting earnings reports. We're in the middle of, the first quarter earnings season. And these weeks have been the big companies, the Amazons, the Microsofts, and what have you that are out there, and Apple. I'd say overall the earnings reports have been good. The one thing we've seen that's been interesting is the forward guidance has been soft. And a lot of the companies have kind of had a little sell-offs because of that forward guidance. I guess the other key area is for a few companies like Microsoft and Google, a little bit lower growth in the cloud computing area than what was expected. So they got, knocked on that also. So, we'll see what happens. Altogether, when you look at what's been going on here, we're going sideways, right? So we've been going sideways since, middle of November. We did hit a new all-time high a couple weeks ago, almost got there yesterday, within 0.5%. We're backing off from that now. But I don't think recession is something that we're going to be worried about too greatly here at this point in time. I think the key issue is inflation and these tariffs, and they actually relate to each other theoretically, right? So if you do a lot of tariffs, you could end up with a higher level of inflation. That's not a guarantee. It depends on who absorbs the costs of those tariffs. But theoretically, consumers could absorb some or all of those costs, which would be an inflationary event. And then if you have higher inflation, the Federal Reserve not only stops lowering rates, they've already done that for all intents and purposes. The next expected lowering is in June. But maybe they don't even do it in June because things are kind of heating up. So if you saw, core PCE inflation growing, right, from 2.8% where it's been at more or less since last May, all of a sudden it's at 3 or 3.5, the Fed's probably going to have to raise rates in that environment. So I think that's why the market is kind of going sideways, just because of the uncertainty for what's happening. And maybe even why some of these forward guidance situations are a little bit, weaker, because we don't know. We're trying to figure out what happens with the deportations of illegal immigrants to those industries. We've heard stories now that here in California that some of the orange fields aren't getting harvested and such like that. So what's that mean? How does that work? How do we work around that? There's always those unexpected situations that get resolved quickly, but not all of them. So it's been altogether, it was down on Monday. It was up every other day for the week, and then down today. Might end up being a down week altogether in the end, as far as that goes. But again, nothing to be concerned about. Let's back up a second and try not to guess what's going to happen, and try not to change our portfolios based on that guess. It is the best way to invest, is to guess only if you're right a lot. You will make the most money. If you are good at guessing or making projections and you're accurate a lot, like more than half, right? You can do quite well. The problem is that there's virtually nobody who's been very good at that on a consistent basis. And so what I say is, hey, let's just sit back and watch and see what's going to happen. Let the market develop. We look at the chart here, we see great momentum. There's a great momentum there. That thing is going well. That can change, but the momentum is something to pay attention to. And then let's just react to how things happen. We don't need to, jump into different things because we think tariffs are going to come and we think we know what's going to happen with them. I would challenge anybody to be able to tell me exactly how the tariff situation is going to play out, because I think it's a situation of flux. I also believe that this administration ultimately doesn't want to bring down the stock market. So that's kind of why I think we're seeing the tariffs being used as a threat and not as an actual tariff as a whole. So, we'll see how that plays out. But anyway, that's what's happening this week. I think it's a very, very interesting time to be paying attention to what's happening to the stock market. We're going to learn a lot about what might happen here over the next 4 years. Coming up here, they're going to be working on tax cuts, potential corporate tax cuts. no matter what you think about the cuts or corporation tax cuts, some people think that corporations should pay more, and all those. I get all that, but the market is pretty straightforward. Higher earnings equals a higher stock market for all intents and purposes. And if you cut taxes, say from 21% corporate tax to a 15% corporate tax, yeah, you're going to have an upwards moving stock market because that increases earnings pretty much immediately. So, we'll see how this all plays out as far as that goes. So far, I think the market is doing fine. It's just kind of waiting around to see what's going to happen, just like the rest of us, for the most part.
And we have some big dates coming up in March with the actual, the federal budget is coming up.
The federal budget, well, the debt ceiling's in March too, so extending that debt ceiling. Trump has talked about wanting to get rid of that debt ceiling, which I could not agree more to get rid of that. I hate the debt ceiling.
But I don't know if Congress wants to give it that power.
No, I don't think they do, actually. That's why they didn't do it when they were first asked to do it. But maybe in this combination bill that they're going to do, it'll be something that they include in there. It's going to be a tough road to kind of get some big bill through because of the minority, the very small lead that they have in the House, for example. And it doesn't take many people that don't like what's in the bill to kind of kill the bill. So we'll see how that plays out. But anyway, that's coming up. We do have some interesting times coming up. I think the first half of this year is going to be all about those types of things. What's happening in Congress, what's in that bill, how does that affect the stock market? Can it get through? Does it make it? Those type of things. So that we'll be talking about that quite a bit. So, all right. So thank you for joining us for the summary for what we saw happening with the market, and let's get into some of the questions and what have you too. See what we got.
So this is more of a public service announcement than a question, but this came up when a client meeting you had. Home insurance and the titling of the house.
Yeah, this was very fascinating. I hadn't really heard this before. This was in the Los Altos, town crier. It was written by a resident in Los Altos, Alex Wang, I believe his name was. He's a real estate agent. It's a very well written article. I really liked it. But what it's talking about, of course, this relates to the fires that are happening, that insurance companies are denying people their coverage if the policy doesn't list the house in the same way that your deed lists the house.
Yeah, so if the policy is in the homeowner's name, but the house is in the, maybe a living trust is the name.
Yeah, so they gave a bunch of examples in the article. If you get a chance, you can look up this article. I think it's really
I'll also post it in the description and also
good.
So everyone can grab it too.
Yeah, because this is worthwhile to follow up with your insurance agent. Like, my house is in a trust. Does my insurance policy recognize that my house is in a trust? And what do we have to do to make that line up? If you have a spouse that passes away and you still have your former spouse or divorce or whatever it might be, you still have your former spouse on the policy, but you've changed the deed. You want that deed, according to this article, to match up to the policy. Now, I'm not an insurance agent. I don't know, how this actually works or even if this is valid, but it seems like a pretty simple thing to do to call the insurance company and make sure that everything's lined up. I do have a gut feel that insurance companies, for the most part, they would love to find a way to not pay if they could.
Yeah.
And so, it wouldn't surprise me if this was true.
Yeah, they're looking for a small technicality, basically.
Yeah, but during this appointment, I told the client I really wanted to share this with everybody, and we'll put this out as a separate video too, because I think this is something that's worthwhile. We've got these big fires that are happening. We have had massive amounts of rain and then very little rain, so that gives for a fire environment. One quick thing, there was in 2019, California hired a professor at Stanford who specializes in kind of fires and fire damage and climate issues and whatnot. And they asked him what were the three places that would be the most devastating to have fire in. And so it had to do with the likelihood of the fire and the cost of the structures that are in that area. Number one on the list was Pacific's Palisades, which is kind of interesting. That was 2019, and it turned out to be pretty accurate. Number two was Los Altos Hills, and number three was Orinda. So I thought that was kind of interesting. So, we have some of those areas here right in our, client base area. So being, prepared for, what could happen.
It should be pretty easy to check.
Yeah.
All you got to do is check what's the what's the title of your house on your deed, and then also what is on your insurance.
Yeah.
And just make sure they match.
Yep.
So
Yep.
it could be 15 minutes of work to
Yep.
just protect yourself.
Yeah, exactly. Yeah, you know, it's a big asset. It's a very important asset. You'd hate for something to happen to it and not have it insured. This, you don't have to have insurance for everything, but boy, on your home, that seems like a pretty big one.
Especially with fire.
Yeah. All right. What's our next question?
So I've seen quite a few companies give weaker forward guidance. Should I be concerned about a weakening economy?
Okay, that's a good question actually, because I was thinking about that myself. We saw it from, basically all the big companies came out with weaker forward guidance. For the most part, the stocks were sold off a bit, at least, mostly based on that weaker forward guidance. And so you have a whole bunch of companies doing that, and you say to yourself, okay, why? So in the past, you would get weaker forward guidance only because the CFOs and the CEOs wanted a lower hurdle to jump for the next quarter. And so, now you're getting kind of penalized for it. So they're trying to get closer. I remember during 2020, they stopped doing it altogether because it was too hard to see what was going to happen. So I wonder if that's not happening now. Okay, so here we are in this environment. We got a new administration. They're talking about things that we don't normally do with tariffs and massive amounts of deportations and lower taxes and all these things. And we got a thin house, margin. So if I'm a CEO and CFO, I'm just as a money manager, same thing. I'm wondering what's going to happen. And so if I have to guess going forward, and so actually, I think this is one of the most cloudy times that I've seen to guess where the stock market's going to go, right? Because we don't know. These are new things. They could have no impact, could have massive impact, could be anything in between. And so is that forward guidance drop because of the environment?
Yeah, if you have uncertainty, you kind of want to you put the lower bar.
Right. Or are we seeing a mass slowdown of some type, right? Well, okay, first of all, the earnings right now that just were reported were good, beating expectations by a majority. Yeah, there's no doubt. And the forward guidance was not that far off. I mean, it was lower than expectations, right? So there you have to adjust the stock price because the stock price is based on expectations for at least, the short term. And so, it's not enough to see, in my opinion, that we're looking at a slowdown. It's too small of a drop. It's too early to tell that. So I would stay the course. Don't worry about it. I still say the threat is inflation and a hotter economy and a higher job growth. I mean, they just revised the job growth numbers for November, December. The number came out today. It was a little bit lower than expectations, but who knows? That could get revised up also next month. So I'm not seeing it. Unemployment dropped to 4% from 4.1. So those job numbers are generally lagging numbers. Consumer sentiment was down, so people are feeling more negative. But sentiment on a survey has been a fairly useless, in my opinion, survey. I don't know why they do it, because really just look at the spending numbers. Look at December spending numbers, unbelievable. And so, I think the consumer is still sound. We still have wages growing at faster than inflation. That makes for a happy consumer. So there's too many other things out there besides some CEOs and CFOs deciding on what they might want to report as their forward guidance for the next quarter. They don't know either, really. I mean, they're no more than you and I, but still. So we're not in that time frame where it was ratcheting up, what we were seeing over the last couple of years where things are really flying. I'm okay with that, to be honest, because this market has gotten pretty stretched out, and we're going sideways for since the middle of November. I don't see that as a bad thing here as far as that goes. So I'm not too worried about the forward guidance at this point. It's you pay attention, but it's not something I would make any reaction to whatsoever. All right, what's our next question?
So, if inflation starts to pick back up, what should I expect from the Federal Reserve or just the market and the market?
Yeah, this is the bigger, I've been saying this for 2 years, this is the biggest risk to the stock market is inflation coming back up. And one of the things you have to realize is the backdrop, the story that's behind what we're dealing with now, and especially the big money managers. They all know this story. So in the 70s and 80s, we had a situation where we had some inflation that came in. They raised rates. Inflation started to come back down. Unemployment and employment got softer, which is exactly what's happened here. Inflation's come back down, and unemployment went from 3.4% to 4.2%. So then they started to lower rates, just like they did this time, exactly the same. But inflation started up again and it went bananas, and they ended up having to raise the federal funds rate to 19% to crack that inflation.
Yeah, they had to basically break the economy to stop
Yes,
inflation.
yes. Now, just for frame of reference, the federal funds rate right now is at 5% ish, 4 3/4, in that range. So we're not, anywhere close to 19%. Now, I will say the one big difference is that oil went from $4 to $40 a barrel in a 7-year period. Right, so 10 times the cost for oil. Well, we would have massive inflation here too if that happened. And so we're not having that. And the U.S. has a totally different situation now. We're net exporter of energy products as a whole, which is amazing, actually. So, um, but here's the scenario: if PCE, the core PCEs, the personal consumption expenditure index, which is the thing that the Fed looks at for inflation. If you look at that core, it's at 2.8%. It's been there roughly since May, 2.6, 2.8. If that starts to go up, we hit 3, 3.5. They're going to raise rates.
Yep.
The market's not going to like that. If you remember 2022, the market dropped 28%. Because they raised rates 5.25%. So we're not going to have a 5.25% increase, in my opinion, unless we get another scenario like we had in the 70s
but
and
it could go
80s.
up to back to 5.25.
It could, yeah, I could see that in a heartbeat, actually. Because actually, I think the average is 6. I don't know why people are worrying so much about these high rates. This is like normal rates. It was great. Just in hindsight, we really love what we had.
But yeah, we got used to a decade of very low rates.
Yes, it was awesome. Everybody hopefully refinanced at some great rate, and we're sitting on these great loans. That's why nobody's selling their house. But yeah, I would expect the market to get very choppy, if not go down, in an environment where inflation's going up. And this is why if you look at the market minute by minute, if you look at like December 18th, the meeting that the Fed had, say, we think inflation, is okay, but they weren't, thinking it was so high they wanted to lower rates anymore. The market dropped 3% that day. If you look at the report that came out in December for the December's job report, 256,000 jobs, market dropped 1.5% that day. So the market is moving on inflation numbers, and the market is moving at least somewhat so on this tariff issue. Dropped 0.75% on Monday, down 1%, whatever today. I think on the tariff issue, because the tariff issue is an inflation issue, and that's, it may or may not be. I know everybody wants a clean thing. There is no clean thing when it comes to tariffs. It depends on who absorbs that cost. It doesn't always have to be the consumer. But somebody's going to absorb that cost, one side or another. Either companies are going to have less earnings, which would be a bad thing for the stock market, or consumers are going to have higher costs, which could eventually stimulate the Federal Reserve to start to raise interest rates. So I think this is a good question, because this comes back to the key issue of what's happening and what we should be watching for. I always like to be able to see what the market's responding to and understand what I should really be focusing on. And I have been focused on inflation for a long time here, because I think it's the threat. I think it's doing okay at this point, but it's something to watch for as far as that goes. But yeah, good question.
So with tax season approaching, this question comes out quite a bit. Do I get 1099s for my IRAs if I am not retired? So an IRA is an individual retirement account.
So yeah, with an IRA, you've got it's tax deferred. So it just means you don't pay any tax unless you take money out of it. And a 1099 is a reporting to the IRS how much money came out of your IRA, right? And so even if you're retired and you're not taking money out of your IRA for whatever reason, you won't get a 1099 until you take money out. Now, obviously, once you get to 73, you have to start taking money out. You'll get a 1099 every year thereafter. The only other time you get a 1099 is called a 1099-R, which is a different one. So if you rolled over an IRA to another IRA, I believe even a 401k to an IRA, I believe that's a 1099-R also. Those are different because they basically just notify the IRS that this money came out, and then on your tax return you basically put it down as a rollover so there's zero tax. But it's just a way to account. I have 60,000 this IRA, I moved it to this IRA, I got a 1099-R for 60,000, but you show on the tax return that it moved and there's zero tax, as long as it was done within 60 days, right? And so, but normally a regular 1099, which is to designate how much income you would have, you would not get that
Yeah,
until you did.
retirement accounts are always going to be 1099-Rs.
Mhm.
So
Yeah,
yeah,
right. That's a good question. It's yeah, it's something coming up. We're getting asked that now, huh? Where's the 1099 on my IRA? Well, you don't have one.
Yeah.
There isn't one. Yeah.
Oh, should I do anything differently with my finances with the new administration?
Yeah, that's a pretty common question that's coming up in my client strategy sessions. Is just what should we be doing differently? Whether it's my finances or my investment accounts and those types of things. I break those down into two areas. If there's something that you're doing that is being targeted by the new administration to try to get rid of it, and your job's at risk, right? Then you definitely should be thinking about what that means in terms of gathering up more resources and saving more.
What elective things can I cut back on?
Right.
So if you have a federal government job, is there going to be any kind of freeze, or are you going to be let go, essentially?
Yeah, well, it's even anything in the public. One of my clients was telling me that their daughter works in public health, and they did a freeze, and then they unfroze everything. But for some reason, their organization's still not getting money. They had to lay off 3 people from that organization just this week. And so, if you're in a scenario where there's federal money that's coming in for anything, whether it's your job directly for the Fed or you're working for some place that's getting federal money, you want to be aware of that. And I think, prepared, starting to save money and maybe not doing such big expenditures, things that you thought. Just wait for a while, let the dust settle. In terms of what's happening with your investment accounts and those types of things, I advocate staying the course because of my basic philosophy that there's 2 ways to invest. One is to make projections and change your portfolio based on those projections and hope that you're right, or watch what's happening and react to that. So there's pros and cons to both. If you're right on the projections, you'll make more than being right on the reactions because you'll be ahead. Right?
Yeah, you get at a lower point, or you get
out at a higher point or get in a lower point because you're making that projection and you're correct. Now, the problem is statistically, we're terrible at making projections. Terrible.
Yeah, individual investors tend to do poorly.
Oh, individual investors are, the Fidelity had a study once. They did 2.1% average rate of return over a 10-year period for the people in their system that were doing it by themselves. Inflation was 3.2% or 3.1% in that same time frame. So they weren't even making enough to keep up with inflation. But nonetheless, just the disadvantage of the reactionary is you got to let things happen. You're going to have the bottom's going to disappear and be coming up, and then you finally get in, or the top's going to disappear and be coming down. You finally get out, or you finally make some adjustments or get more conservative. But what happens is you've actually got some more proof. You're in the momentum, kind of the sweet spot of that move if it's going to continue. And so again, there's pros and cons to both. We believe in kind of momentum-based, reactionary investing. So if you look at that, look at the S&P 500. Let me show it. Here we go. What are we reacting to? It's been going sideways. That's not spectacular, but it's not bad since mid-November. But that's a pretty good chart. I mean, things are going pretty well. The market is not responding massively negative to what's happened so far with this administration. It's early. Maybe they will. But let's wait and see as far as that goes. Now, the bond market's kind of a different animal. The bond market actually has been reacting fairly negatively to the market. Maybe that has to do with the current administration. The bond market's much more concerned about kind of a weird combination of things. First of all, inflation, right? Because if the Fed starts raising rates, bond values go down. But secondly, even the tax cuts, right? So if you have tax cuts and you don't have appropriate amount of savings to offset those tax cuts, the bond market takes the brunt of that. They have to sell more bonds to cover a larger deficit. And the bond market is already fairly stretched because we have a fairly high deficit. So you're selling a lot of treasury bonds to sponsor ourselves. In England, Liz Truss, I believe that was her name, was a prime minister for about 2 weeks or something like that. And she came in and tried to do tax cuts with no accommodating savings. And they had to bail out the bond market in England. The Bank of England had to step in and bail that market out. And that was, it's not the same. We're not England. We have a much more liquid bond market, but it is similar in the concept. So, we've already reacted to the bond market. We have a majority of our bond market positions in T-bills, and we've had that for a while, just because the bond market's kind of worried more even than the stock market about what might happen with the different policies and procedures. Because theoretically, tariffs are inflationary. Deportations to a large degree, if you do a lot of them, are inflationary. And the bond market would be more stretched in a tax cut environment. So if you look at those things from a bond market standpoint, be more worried. Now, I also feel like once all the dust settles, the bond market might actually have a pretty good run, because we have had, assuming we don't have inflation, we have had lowering interest rates, and the bond market has actually been coming down for the most part, and it might try to do some catch up. Because the bond market is going to make you 4 to 6%, some 5% to 6%, whatever it might be. And we're not getting that at all. And so, generally speaking, when you're not getting something in a market that you should be, the averages will work out. And so there'll be some period of time when the bond market tries to make up some of that, and we might have some decent returns.
The bond markets had a bubble during the pandemic, you could say, and so it's kind of averaging out.
Yeah, exactly. So anyway, long answer to that question, but I think it's come up a lot. People are worried about what's happening. Just be assured, number one, that things aren't going that badly yet, and they might not. And let's just wait and kind of see how things develop, because we don't know, and I'm not even sure anybody knows exactly how this is going to play out. Because it's not only does it play out, then what impact does it actually have? Because a lot of times you think, oh, tariffs are going to do this. Well, maybe not, right? I mean, you got to give some credence to the projection possibility that the market just takes off. I mean, it just skyrockets because we got a 15% corporate. Nobody's talking about that really. It's possible. As a matter of fact, that's probably more probable, unfortunately, because everybody goes one direction, starts to think one way. The market does the opposite almost every time. I'd say 9 out of 10 times. So, keep an open mind and just keep flexible. We're in a basic portfolio on our stock market standpoint anyway that seems to be doing okay. We're hanging in there. So anyway, that's a good question, though. It's been coming up a lot. All right.
Should I be worried about my Social Security benefits changing?
Oh, that's a good question. That's coming up a lot, too. Because if you're going to cut taxes as much as they're talking, we're going to get rid of taxes on tips. We're going to get rid of taxes on Social Security. We're going to reduce corporate taxes down to 15%. Some rumblings about tax cuts on capital gains. And so, I don't know what the total is. It's high. And what they have to do in this process, in the reconciliation process, because they can do this without a majority of the Senate, and they can make these things go through with without 60 votes in the Senate. They can do it with they can do it with 50 or 51 or whatever it works out to. And so they look at a 10-year period, and they say, okay, we've got 10 years. We're going to cut all of this revenue. Where are we going to save? So we're going to hassle all the federal employees to make them try to quit, but there won't be enough there to cover. Believe me, there isn't enough. You can't cut enough to probably make it work without getting after the three biggies: defense, right, Medicare, and Social Security.
Yeah, entitlements are considered like the biggest cost.
I think it was 2/3 or whatever it is, right?
Yeah.
So some of these discretionary things that they're going after in total with Musk and such, it's like less than 10% of the total budget, and the tax cut they're talking about, you're going to need more. So maybe there's an offset with some tariffs money coming in as a revenue source, so that'll be interesting, and that's one thing they're trying to do. Actually, I'm not sure it will work, but Social Security, in my opinion, I don't think it's possible whatsoever that they could cut current people's Social Security checks.
Yeah,
I don't see it.
It would be a political bloodbath to do that.
I don't see it. I'm sorry. I know it's a worry. It's a concern. I don't see it. But they have other ways of doing it that's a little bit more sneaky. Number one is, and they've already done this in the past, they can change the way that they figure out the cost of living increase so you get less cost of living increase. They did this already. They have a special bucket for seniors. The CPI is a normal bucket of goods. They have a senior bucket of goods. And so there is less money paid through. And so instead of getting what maybe next year would be a 3% COLA, you get a 2% COLA. And one of the reasons that works is because people can't tell, really. I mean, it's very difficult to figure out how that calculation worked. And so if you take that out over a 10-year period, right, they're going to say, okay, we're going to save X amount to go towards this deficit because we're lowering taxes. Then the next thing they can do is, I think, very likely, or not very likely, but wouldn't be this political bloodbath. You could cut the benefits for people that are not getting Social Security yet.
Yeah, and essentially just push out the full retirement age.
Yeah, lots of ways of doing that, actually. But yeah, exactly right. You say, okay, full retirement age is 67. If you're not getting Social Security yet, we're going to move the full retirement age to 68. That's going to save X amount of dollars. We put that on this big list of savings to go against these tax cuts. So I could see that. I could see that being part of this, actually, and they probably would survive politically because of the way that works. I cannot see, anything's possible, but it would be suicide to say, okay, this person's getting $2,000 a month, and now they're going to get $1,900 a month.
Yeah, so many people depend on Social Security. Yeah. It's their only source of income in retirement, and so they would just be out in the streets, basically.
Yeah, the average American, and the stat's a little old, but it's probably still in the right neighborhood. The average 65-year-old American has $49,000 in assets plus Social Security. So you start cutting back on Social Security, you're going to have significant trouble. Oh, I guess one other way they could do it, if they were going to cut back on Social Security, they could means test it. So if you're over a certain amount of income, we'd cut back on your Social Security, although that's not a Republican standard. Right, that's not usually what they're looking at, right? I mean, just as a party. But anyway, so they're, they'll probably try to do all kinds of little things like that to make the numbers work to get through this reconciliation process. So yeah, I think that Social Security could take a little bit of a hit. They really need to fix it, and they need to figure out how to get past. The Social Security Trust runs out of money. Depends on which projection you look at. Sometime between 2033 and 2036.
Yeah,
so
seems to be
the
they either got to
seen.
pump in the money that's going in, cut the money that's going out, or figure out how to get higher returns.
Yeah, they've talked about that too, right? The privatization, not the privatization, but the investment of the Social Security money, because the trust has excess money in it, right? At least at the moment. And so, could that be invested? Or even more, directly does your money directly go into what would essentially be a 401k? Yeah. And you might even get some choices, and you can take your Social Security money and watch it grow. And, that came up in George Bush Jr.'s tenure, and it didn't make it, but, who knows? I'm sure that'll be revisited again. So anyway, those are the types of things that happen around Social Security. I think it's a good question. I do think there'll be some adjustments potentially, but I don't know that they'll be as dramatic as some people might think. Just because you would wipe out the party for quite a while, I think, if you did that. And there's too many people that still, maybe this is the last term for Trump or not. He keeps going back and forth, but nonetheless, there's too many other Republicans that are going to sit there and say, well, wait a minute, I'd like to come back, for my next term, and I don't want to vote for this. And they just get a couple of those people in the House, and it won't go.
Yeah, you have such a slim majority.
There is not enough majority in any side of either side of the equation to cut Social Security payments for existing people. There will be more than 3, 4, 5 people that it takes to kill a bill in the House, especially, that wouldn't vote for that because they want to come back. So it'll be something else, but I think you could get by with the COLA, things that you could describe as kind of making sense, because of the situation. Because if you do cut back somebody's Social Security taxes, that's increasing their payment, effectively, right? If you got rid of Social Security taxes, that's a huge boon. They might be able to sell that, right? We're going to cut the tax by X, so you're going to gain. So you get $2,000, but because we're cutting the tax, you're actually getting $2,200. So we're going to cut back your thing to $1,800 because you're going to save it on tax. You're still at $2,000, or we split the difference. Yeah. Cut it back tonight. So that'd be a hard sell just because it's complicated, but it is a fact. I mean, if you get rid of Social Security taxes, you've just made Social Security a higher benefit to you, right?
But
otherwise,
probably burns the money much quicker too, though.
Oh yeah, well, it does. They'll have to come up with some other solution for Social Security long term if they're going to take away the taxes, right? Because all of a sudden that 2033, 2036 thing starts coming back to much quicker before the Social Security Trust runs out of money. So, okay, good stuff. Really good show today. We're finally back. We'll keep going here. We'll be back next Friday too. Send in your questions. Ask Tom at talkmoneywithtom.com. Send in give us a little chance to look at them and think about them, maybe come up with a chart or something, whatever we might do. And then, of course, if you want to subscribe to the channel, I encourage that. I think we have a lot of resources on here and a lot of things that you can look at. And then, of course, if you want to meet with us, feel free. Our book appointment button is up on the corner of our website. Links here on the channel, and set up a time to meet with Ethan and I. So, otherwise, we'll see you next Friday. And thank you so much for joining us today.